Open and the Nifty Sensex rates will be up on your screen. Then we'll get to stocks. Nifty is up at 22,979. So in the green, the Sensex is at about 75,492 at this stage. So these are mildly higher sort of starts. 30 points is what the higher start is for the Nifty, and about 70 points on the Nifty Bank. Mid-cap index is starting about 140 points higher. That's about 0.25%. And I think you've got the small cap index, which is also starting somewhat in that range higher. Mid and small cap indices, by the way, were firmly up, 0.75% gain by close yesterday, even as the Nifty did sell off. So keep an eye out, on that one. But let's take it to Sonia, who's got the stock list. Sonia.
Well, thanks a lot for that. So as you rightly pointed out, it is the Nifty is holding on to gains, right? But here is where the action really is. The Nifty Bank just short of that 50,000 mark. It's up about 100 odd points. So I'm going to take it straight to one of the largest banks, HDFC Bank, which has been seeing some action over the last couple of days. UBS has a buy. They have a target price of 1900. That is the brokerage this morning. IFL Securities, we just spoke to the banking analyst who said that most of the negatives are now behind HDFC Bank, and they have a 1760 rupee target price on HDFC Bank. So this is one stock that I'm looking at this morning. Nalco, as Nigel was telling us, strong earnings, highest quarterly EBITDA in the last 2 years. Look at that. EBITDA is up 44% and the stock is cheering that, up 5% right now on Nalco, one of the big movers on both price and volume action. Keystone Realtors is the other one I'm looking at, about 1% higher. The company has successfully raised 800 crores via the QIP route, so that's a positive. United Spirits is the other one. Premiumization trend is intact, and the company has spoken about a double-digit revenue growth in FY25. The stock is charging ahead, up 2.5% as we speak. Couple of PSU banks in focus. I'm looking at Canara Bank because this morning Motilal Oswal put out a note. They had a buy, but they've reiterated a buy with a target price of 140 on Canara Bank, so there's some upside left. They talk about how asset quality is improving, consistent decline in NPA ratios, and earnings growth will sustain at 15 to 18%. Let's hop across now to NMDC. The earnings actually missed estimates, so you can expect some red over there. The top line was in line, but the EBITDA was a miss by 16%. So NMDC is the one that is taking it a bit on the chin this morning. Adani Enterprises, the board will be meeting to consider fundraising today. This one is always in the news, so up almost about 0.3%. Inox Wind, let's pull that one up. 22% equity has changed hands now on Inox Wind. As was expected, that large trade has taken place and that stock is now down almost 8%. I think 153 is the price at which the 1.2% equity, 1.2% equity is on PB Fintech. So the two large deals that we're looking at this morning. So just keep an eye out on both. But overall for the market, look at this. Not bad, given that we've had a very strong run. We continue to chug along. Just shy of that 23,000 mark, and the Nifty Bank is the one that's really participating, 100 points in the green at opening. Back to you guys.
All right, thanks a lot for that, Sonia. Well, a couple of stocks. NMDC has recovered a little bit from the low point of the day. The street was factoring in that there'll be a price hike that will be coming about, so that's why it's cut its losses. It was down 2%. Now it's as flat as can be. Nalco, well, the stock is flying away. That's one of the big gainers today. It's up closer on 2.5%. Volumes as well. Actually, it's up 5% as we speak. Coming out of the F&O ban, and big beat in terms of the EBITDA number, 15% higher than what we were working with. Let's focus on a few stocks. Then you have Arvind. That stock is one of the top gainers, so Arvind Limited should come up for you. Sumitomo came out with a set of numbers, beautiful numbers out there, so that stock is well up and about in today's trading session. You have Natco. Well, that stock, in fact, is flying away. That one is well up and about in today's trading session. Timken, well, that stock as well is doing pretty well. It's recovered, a big recovery from the low point of the day. It's up closer on 4.5%. Welspun Enterprises, that's another name in there that's done well. So that stock, in fact, has bounced up. I think it's moving higher and one of the top volume gainers. On the flip side, let's pull up a few stocks. Adore Welding, I'm not sure what's going on with those numbers, but that stock, in fact, is down closer around 10% as per our record. So that stock gets hit. You had Arvind Fashions, that's down closer around 5%. So that as well is coming up on the losers list. AGI Greenpack, that's another stock that's down by closer on 5%. And Praveg, that's the tourism play. The stock had gone to around 1,200 rupees. It's now at around 820 rupees. The numbers came out, it was a little bit disappointing, and some of these stocks have seen a big run. So Praveg is another stock from the BSE listed stocks that's down close to around 6% as we speak. Prashant, what else?
So it's a 40-watt point higher start on the Nifty, and it's looking pretty steady so far. So 22,973. Nothing big, nothing large, but just a steady, decent open is what you have. The Nifty Bank is up about 0.25%, actually 140 points. So 49,440 on the Nifty Bank. Maybe just a few more names before we take it to Manish Gudwani, who's with us on markets. Hindustan Zinc is starting about 3.5% higher. It's got large volumes for this point in the day. There is Hindalco, which is up 2.33%. So these two names from the commodity side are looking good. Nalco, of course, we've been talking about. Sumitomo, we did. United Spirits. Capacite Infra, that's another one which is up about 3%. It's coming out volume, so maybe that's just taking a mention. RR Kabil is up 5%. RR Kabil is also coming up with decent sized volumes. There is Novama, which is up about 2.33%. SW Solar is up about 2.25% or so. Arvind Limited is up 9%, 381 on Arvind Limited at this point. And then there is Torrent Power, which is starting about 3.5% higher as well. So, just a few more names in the broader market which are coming up right now. BDL, Bharat Dynamics, is down 4%. And Phenolics Cables, of course, very large, 40% pull, run up. And today it's down about 3%. So a little bit of pullback coming through, but large volumes here. Garden Reach is also down. Phoenix Limited, Borosil Renewables is down about 4%. On the other side, Nazara is down another 2%, and AstraZeneca is down about 2% or so as well. So this is the long and short of what is up and what is down for this point in the day. Manish Gudwani is with us, CIO at Bandhan Asset Management Company. Manish, good morning. Good to have you with us here. Thank you very much for your time. So from here out, Manish, what are the themes most likely to play out? Because the market, of course, believes that elections, of course, are going to be a big one, but very comfortable with the idea that there will be political continuity, etc. So you've got to think ahead. What are the big macro themes and sectoral themes which will likely play out where one can still make money? Manish, let's start there.
So from a macro perspective, I think the biggest positive spot is the currency to our mind. Both from the perspective that the dollar is likely to be weak to our mind medium term. And the fact, probably more convincing, is the India side, where we're seeing almost a once-in-a-generation shift from current account deficit to a structural neutral current account. So that way, I think for us, one of the big macro themes is the relative strength of Indian currency versus its history, which to our mind can attract a lot of foreign capital. That's on the macro side. On the micro side, we continue to remain broadly positive on the themes we've liked during the last 1 year, which is namely power capex, auto, and pharma. I think these are the three themes, also real estate. So maybe these four themes are what we broadly overweight in our portfolios. Largely domestic, because one is the domestic economy seems to be having more momentum, higher growth, better macro stability than the global economy. And two is that even from a valuation perspective, some of these themes we think are, given the kind of growth that may happen, given the kind of multi-year cycle they are in, we think the valuations are pretty reasonable.
Sorry, I was trying to come in there, but I'll come to individually these sectors. But on the rupee, which you said that's a big one, are you expecting the currency to strengthen? Is that what you're saying? Or the rate of annual depreciation will be much lesser as compared to history?
See, that will depend on a lot on RBI's policy. I think if we are trying to match Asian currencies because of manufacturing and being competitive, then it may not really appreciate too much, but our forex reserves may keep going up. But the point is that even if it is, let's say, flattish for 2-3 years, I think that's a big break from the past, because historically we've seen 3 to 4% annualized depreciation of the rupee. So a currency which looks to be depreciating a lot less or maybe even flattish, when you see the yield on Indian bonds or Indian fixed income or various Indian assets, and assume that the currency is going to be flattish or not depreciate more than 1%, then I think in the global context, it is very healthy return, which is why I think that medium to long term, there'll be a lot of foreign capital flowing into India of various kinds, whether it is FDI, FI, debt, NRIs buying property, various kinds of capital will come in.
Okay. Manish, hi, good morning and good to see you in after a while. What is the best way for retail investors to approach this market now up until elections, right? Because the long term is intact, we all know that. But in the very shorter term, given that we are sitting at all-time highs, there's some concern about the outcome of the elections not being as favorable for the market as one would have expected about 6 months ago. Your thoughts, and for the here and the now, what's the best advice?
Look, a lot of times in markets, we face these events which are very difficult to predict. And honestly, I think risk management is the key word out here. So everyone should be very clear what is the objective. So for us, for example, if you're benchmark investors, our risk is how much do we deviate from the benchmark. For retail investors, if they are more absolute return focused with a bigger priority on downside protection, that is a different risk profile. But once you recognize the risk profile, I think such a big event, you're better off not taking too much risk. So I think it's perfectly natural for like a fund manager, if they were to go closer to the index, I think that would be perfectly natural and a decent way to handle this event. Similarly, for retail investors, not to be either too over allocated to equities or under allocated to equities is, I think, a good way to handle these big events.
But in terms of, if one wanted to focus on sectors, right, banks have come back in a big way, or at least that's the expectation. Some delivery buying is picking up in private sector banks. Is that a good way to do it? I mean, allocate a little more to private sector banks now, especially the ones that have underperformed like an HDFC Bank?
The banks, I think, are a decent risk reward. But I do think that they are not going to be the leaders of the bull run because A, they're too big, right? I mean, some of them have market caps of 100 billion, 150 billion, whatever. And typically in a bull run, newer sectors get uncovered. So I think, as I said, I think it's good to have decent allocation to banks. But some of the other themes like industrials, power capex, auto, pharma, I think they look more interesting at this point of time.
All right. Hi, Manish. Good morning. Since you mentioned autos, I recall you were bullish, I think, on two parts of autos, PVs and two-wheelers. They played out well. CVs, I don't think you were that bullish. So tell us, what is your current stance on it? Because that's worked out, the overweight stance on autos. Does it have more runway as well from here?
Yeah, I think some of the passenger vehicle, two-wheelers and four-wheeler stocks have become slightly more fairly valued versus last time. Incrementally, I'm a bit more bullish on CVs because, see, traditionally what we've seen with CVs is that it goes through deep down cycle and a sharp up cycle. But the sustained momentum in the economy today could mean that the last 1 to 2 years of consolidation we've seen in CV volumes, unless we see a bit kind of global recession or big unexpected shock, we might see the CV cycle bottom out at these flattish volumes. And also from a valuation perspective, now when you see what is being built into capital goods stocks or a lot of other cyclicals, I think one needs to think through that if these stocks are building in so much of capex and infra happening, will we actually, if that turns out to be true, then the CV volumes have to do relatively okay, I think. I don't think you can expect a CV down cycle and capital goods stocks delivering 30-40% growth. I think that's a bit of a, usually it doesn't happen that way. So incrementally, I'm probably not going to go massively overweight on CV cycle, but some exposure might be okay, I feel.
All right. We'll leave it there. Manish, great speaking with you. Thank you very much for your time. Appreciate you joining us here on CNBC TV18. Thank you for joining us. Well, you know, you got the market, which is up 50 points. We're at 22,985. So it's a decent start. Market breadth, maybe it's too early, but maybe not. 1,200 stocks are higher, and you got about 900 stocks which are lower.
I just want to mention two stocks which we had focused on yesterday as well, Ashok Leyland and Exide, right? Both those stocks are up once again and up by good volumes. Ashok Leyland is now at 230. Volumes are picking up quite a bit. And look at the volumes on Exide. I mean, this is a stock that is now up almost 60% this year. So big rally over there.
Okay, all right. Well, let's focus on another stock, Laurus Laboratories. Well, to understand about what's the way ahead, we're joined by Dr. Chava, the founder and CEO of the company. Hi, sir. Good morning and good to see you. Well, there's been a rumor on the market for the last, 40 days or thereabouts, and you briefly spoke about it in your con call as well. The alternate API supplier for some new innovator. Could you tell us what is the timeline by which we could hear about this? Because the street believes it could either be Merck or MSD. Tell us more about that, about this opportunity. You briefly said, I think, that it was in initial stages. So timeline, and is it Merck?
We don't want to comment on the confidential projects for our partners. But we can tell you there is a definite shift from the big pharma and also large biotechs to diversify their supply base from one country to multiple locations. And we have seen that shift. And we have expanded capacities. We have expanded our technical capabilities as well. And we believe we have invested in capacity expansion at the right time. And we, as we mentioned in our con call, we are working with six out of the 10 big pharma. And we believe our CDMO will definitely will be a driving force for our growth medium to long term.
Right, Dr. Chava, we'll get to that. But, you also mentioned that you're looking at being the alternate API supplier to an innovator. And it's in initial phases. So just on this, by when could we hear about the outcome of this potential large-size deal that you could be bracing for?
We already supply 4 APIs for NCEs for various big pharmas. And this year is going to be a very remarkable year for us because there are 2 NDAs being filed using our API in the US. So once the NDA, the approval will be less than 12 months, then we will have commercial opportunities for 2 APIs. And there are multiple phase 3 projects under execution, and we believe we'll have a good times in the CDMO in the near future.
Mr. Chava, no, so this is not going to be transformative, right? I mean, this is something you already do. So there's going to be one more customer in that sense. Or without getting into anything, we said this is confidential, so we won't push you. But is this transformative in terms of the size of the opportunity?
Definitely, these are high-priced, large-volume products where NDA is being filed. These are not small. These are not in single-digit million. This is a multi-million-dollar opportunities we will capture once the NDA is filed, and then we start supplying the commercial volumes. And and also we have seen a lot of customer visits also happening. That is also an indication that big pharma and large biotechs are looking at diversifying their supply base.
Right. But, so multi-million-dollar opportunity per year. So this is not small. I mean, that's how much you would tell us at this point. So maybe we'll have something definitive sooner. Now, the other thing is this news about the US FDA issuing an untitled letter. This is on the 16th of May for your manufacturing facility in Andhra Pradesh. So summarizing deviations from the GMP practices. The inspection happened in December, 4th through the 12th of December. Could you tell us the status of this? And with regards to the US FDA compliance, I mean, is this plant affected? What is the percentage of sales from this plant as a percentage of your US revenues?
We acquired a unit in 2020, which is called Phalanx Labs. When we acquired this site, already as an import agent. So we took that facility and did remediation measures and used that for in-house intermediates. Based on the in-house intermediate usage, FDA inspected in December 2023. We responded to that. And FDA sent another correspondence in 16th of this month. Untitled letter, as per FDA forum, regulatory documents, is a correspondence to the industry where the GMP deviation doesn't meet the threshold of a warning letter. This is a correspondence with us, gives us an opportunity to address the two more issues. So we had a 5.483 when FDA inspected. In the untitled letter, they only raised concern on the 2 points. We will address that. And this unit contributes less than 1% of our revenue. And also, this unit is not used for any of third-party regulatory sales. There are no DMFs filed from this unit so far. So this is, we believe this is, we are trying to resolve the issues of the import alert on that unit. And we don't see any impact on the corporate level.
Okay, fair enough. Mr. Chava, good morning. This is Sonia here. So you're saying this unit is about 1% of your overall business, so there's not really too much of an impact. So let's move on. I want to ask you about the CDMO business, because there are some concerns about delays in a couple of your critical CDMO projects, and your business was up only 4%. You saw growth of just 4% in the quarter gone by. Can you tell me what is the outlook? By when do you think you can get back to double-digit growth? And these, concerns about the delays in some of your projects, would you want to alleviate any of those concerns?
See, there is no delays in the projects. If you look at the drug discovery from phase 2 to phase 3 to NDA and all, it takes its own time. And that's the reason people who are in the CDMO business, they're fully aware. A CDMO business is very lumpy. So you can't measure the CDMO business quarter on quarter. But we know how many projects we're handling and what are the customers' interest in us, what kind of technology upgradations we have done. So we are very bullish on this segment.
Okay, so you're saying that the business is lumpy, right? So even if you look at it annually, I mean, you were sitting on about 2,100 crores in the CDMO business. That's come down to about 920 crores in this year, in FY24. So that is a significant fall. Going forward, what kind of growth can you look at in FY25? On an average, what are you looking at?
It's going to be significant growth in this year.
Okay, so when you say significant growth, what could it be? 15%, 20%? Let's look at it quarterly, right? I mean, quarterly you're doing about 200, 240 crores in the CDMO space. Can you take that up to 400, 450? Any indications?
We want to comment the CDMO business on the yearly basis. This last year, as you mentioned, we have paid more than 900 crores. This year will be, we see significant growth. I will leave it that way. Significant, you could guess. It is not teens. It is much higher than that.
Oh, okay. All right. So we'll take significant for that. But Dr. Chava, give us 2 numbers. And this is for the company on the whole, not talking about the segment. But so let's focus on that. Margins, in the last year, what was encouraging is that the margins steadily recovered all through the year. And the quarter 4 margins were much better than the quarter 1 margins. So that was good. So on the margins, when do you get to 20% margins? If you could give us a rough number that we should work with for FY25, that's point number 1 on margins. And debt is a little bit in excess of that 2,000 crores, but you're doing some capex as well. So you'll get the benefits in the coming years. What is the guidance on both these two? Margins as well as on debt. You could give us a range, sir, if you don't want to give us an exact number, but give us numbers.
We believe we will do, as we also mentioned in the con call, we hope to do 20% plus EBITDA margins this year. What we measure in our business is the gross margins. Are we doing better in our gross margin? Answer is yes, we're able to maintain around 50% gross margin for business. As we are not clocking revenue, our EBITDA margins coming under pressure. As we increase our revenues, things will be fall in place, and we believe this is the year where we will start improving our EBITDA margins. That is on the EBITDA margins.
On the debt, sir, you're going to give us debt. So margins for the year on average, it will be 20% as the gross margins are holding firm. So that's good. What about on the debt number from around this 2,300, 2,400 crores?
I think we will not increase the debt. I think, as we mentioned, we will not going to cross 2,500. And because we have done major capex already in the last 3 years, this year we do about 700-800 crore capex. That will come from internal. We don't need to raise any further debt this year.
So will it come down, but from this 2,500
crores? Will come down. Yeah.
In
come down.
this year, by how much? In FY26, by how much?
We don't want to comment how much, but definitely it will come down.
So, and on top line, sir, what numbers should we sort of expect for FY25? What kind of growth from 5,000 odd crores?
We'll grow. That's what we stop giving the exact guidances. But this year will be definitely we'll see growth in all segments: generic APIs, formulations, oncology, CDMO. This year will be good for us.
Between 12 and 15% growth possible?
I'll not comment on that.
Because we have some numbers here, sort of, and the base range where expectations are between 57 and 5,800 crores. Would that be in the ballpark?
Yeah, we don't want to comment, but as I mentioned, we'll have a significant growth this year, and all divisions are doing good.
This ARV business, the antiretroviral business, did quite well. The ARV formulations was up almost 25% year on year. Can you tell us in FY25 what kind of a sustainable growth do you see in ARV?
ARVs, we don't expect significant growth. We believe that will stagnate the current levels, but remaining segments are growing very good.
Okay, so why do you say you will stagnate? I mean, it's been a strong year for you, right, the last year. So what is the reason for ARV seeing stagnation and growth?
The number of new HIV patients being getting into the treatment is limited now.
Okay.
And there are less new infections. So the number of people on the treatment is not growing much. So the growth is also limited because of that.
Okay, just one quick word on Immuno Act. You have a 34% stake there. What is the plan going forward? Do you plan to raise your stake further? And, what is the contribution that you see from Immuno Act?
As of now, we don't have any plans to raise. They don't need money. They are well funded. We did 2 tranches, and they started commercial supplies, and they're doing good. They don't need more money.
Okay, Dr. Chava, you've given us a fair bit of detail and some color as well on the business. Final question before we let you go. A couple of years ago, to 2023, the guidance was around $1 billion, I think, in terms of revenues. And then things, they changed and you couldn't get there. If you have to hit that $1 billion of revenue, which year will it be? Will it be a story of FY27? Street has been waiting for the last couple of years, actually, and got very excited. But then that guidance started getting, pulled back, and the goalposts moved as well. So by when? 27? 26?
I think now for us, we have to demonstrate by numbers, not by saying any targets now.
But you must be having an aspiration, sir.
Yeah,
You must be having an aspiration.
We have aspirations, but our aspirations are big. But we will show those in delivering numbers.
Well, that's
better way to do it.
That's a better way to do it. Mr. Chava, we appreciate it. Thank you very much. But I think you gave us a sense, and you're sounding confident without putting exact numbers there, which you have done in the past, and for whatever reason. So yeah, I mean, do it and then say it. 20% margins though, 20% plus margins compared to the 15.5 that you did in FY24. That's looking very healthy. So we look forward to speaking with you again, sir. Thank you very much for that conversation, and good luck. We'll take a quick commercial break here. We are going to be back with the management of EID Parry, and we discuss their fourth quarter earnings and outlook for FY25. After that, we'll also have the management of PI Industries, where we talk earnings. Stay with us.
Welcome back. Well, let's focus on EID Parry. We have with us Mr. Muthiah Murugappan, the whole-time director and CEO of the company. Hi, sir. Good morning, and thanks a lot for joining in. Well, let's focus on a couple of aspects of your business, and let's start off with the distillery business. You know, you've gone ahead and you've increased the capacity from, I think, 417 KLPD to around 500 KLPD. So for this year, what is the volume we should be looking at in litre terms? And what does it mean in terms of revenues? The last time I recall a few months ago, you were telling us that that number is likely to move up. And also as a contribution of the total pie, distillery will contribute more. So please tell us that, sir.
Very good morning, Nigel, and thank you for having me on the show. So the distillery segment was doing very well up until Q3. We were growing at about 35% year on year. There was a policy change in Q3 wherein ethanol blending program, the diversion was pulled back, and subsequently our growth slowed, and we ended the year with about a 19% growth. The policy has still not moved back to the original policy framework, and given this, we will probably maintain the same or sort of slightly under growth trajectory going forward. In terms of capacities, we're a little bit above 500, sort of about 520, 530 KLPD right now. This will move up closer to 600 when another distillery is commissioned in Q2. So this is the kind of growth that we're expecting in the upcoming year.
Okay, all right, Muthiah, you want to give us it in litre terms? I think you were looking at doing something in excess of around 12 to 14 crore litres for the last year. What did you achieve in the past year, and what are you looking to achieve? And I think in revenue terms, it was around 800 crores. So we're saying you grow in high teens, you'll be in the vicinity of around 950 to 1,000 crores?
That's correct. And in terms of volume, we will be closer to 16.5 crore litres. Again, if there is a policy change and we remain hopeful, this can move slightly above that.
And in margin terms, what will it be? It'll be in the same region that you have been delivering?
So we closed F24 with an EBITDA margin of about 12% on the distillery segment. I think we were on track to get to about 16-17% up until the policy change. We'll likely hold these margins going forward, and I think if the policy is reverted to, then there's perhaps a scope for margin improvement.
Okay, Muthiah, hi, good morning, and thanks for joining in. So that's on the distillery segment, but I want to talk a little more about the staples category in which you're trying to expand. And you have said that your aspiration is to capture more than 10% of the kitchen shelf in every household in South India. So tell us a little bit about that. What is the kind of investment that you're making here? When do you hope to get returns from it? And what is the potential that you see in this space?
So thanks, Sonia. So the staples category, we see it as a natural extension. We have branded sweeteners over the last 5 years, and we've had good success, but it's obviously a small component of the kitchen basket. We see staples as a natural extension, and also we see some of these categories, rice, dal, millets, all only sort of sub 20% branded. So there is a good headroom for growth, and there's a good headroom to leverage the equity of the brand. In terms of the strategy, we're starting with the straight. So, it is the base level products which are going in, helping us build distribution at the retail as well as the wholesale level. There's obviously a synergy between the sweetener distribution that we already have. And I think once this base distribution is in place and has expanded, we will look at value-added, higher gross margin categories within the staples segment on the lines of, roti mixes, dosa mixes, upma mixes, so on and so forth. So this is something you will see once distribution is well established.
Can you tell me, in terms of the investment, how much investment are you going to make now over the next 1 to 2 years? And when do you expect to see a break even?
So from an investment perspective, this is largely, product development related, manpower related, and A&P spends. Overall sort of consumer business, the A&P spend last year was about 35 to 40 crores. This will grow by about 50 to 60% in F25. In terms of break even, I think it will take us some time until we build the critical mass from a staples perspective. If you look sort of slightly more medium term, we're aspiring to build, a much larger consumer franchise than we already have. The sweetener franchise is about 550 crores, with staples coming in that will aggressively grow. And I would say towards the end of the decade, we would like to build a substantially larger business with a late single-digit EBITDA percentage. That's what we are working towards.
So you've launched in Andhra Pradesh, Telangana and Karnataka as of now, right? What is...
As well as Tamil
you
Nadu.
plan to... In Tamil Nadu as well. Do you plan to expand geographically a lot more this year?
The focus will remain on the south.
Okay.
This is where our distribution, the focus will remain on the south for now.
And got that. Mr. Murugapan, hi, morning, Prashant here. Last time we spoke, you said the nutraceuticals business is under some strategic review. Could you give us a sense of, has that moved? Has that moved forward in terms of what you want to do with it?
So Prashant, I would still say under strategic review. We have wound down our operations in Chile, and some of the other segments. We are sort of subscale, so we still continuing to look at alliances and look at opportunities for value creation. So it is still under review. We'll obviously make intimations once we have a clearer path around that.
So, got that. So, across, on an overall basis, I mean, sugar, cogeneration, ethanol, everything combined, refinery, could you give us a sense of the total sort of earnings growth that we will see, top line growth that we will see in FY25, Mr. Murugapan, and also margins on an overall basis that we should expect?
So, Prashant, we don't give guidance, but let me give you a sort of picture going into F25 in terms of how we're seeing the business. If you look at the sugar and distillery segment, from a sugar perspective, climatic conditions are improving. So this augurs well for the business going forward. Last year, especially in the southern region, was plagued by deficient rainfall. This impacted recoveries and yields. With climatic conditions improving, the outcomes from a farm perspective and an operations perspective should improve. We're also going to start the year with about 9 million tons of sugar stock, and this is encouraging and gives some leeway to perhaps for the policymakers to perhaps consider exports, as well as resume the diversion as per the original ethanol blending policy framework. So these, I would say, are the positives. The FRP also has been taken up by 8% this time, so that should have also encouraged cane planting. So I think we remain positive, but it's also pending how policy pans out. So this is from a sugar and distillery segment. I think we spoke about the growth path of the FMCG piece. Lastly, on the refinery as well, we've had a better operating year, and this is due to higher demand for whites, better cash premiums, and better spreads. We are hopeful that this momentum will hold, as there is still a bit of a supply crunch in the global market. It remains to be seen whether India permits exports. Then the sort of global balance situation will have to be looked at.
All right. What was your export quota for last year, and what is it this year?
There is no export quota, Nigel.
Right.
For.
Oh.
Yeah.
Okay, and on your total sales mix, I think you had some percentage of your sugar sales which gets a higher realization, right? So could you run us through what is the percentage that gets a high realization, and what is the difference?
So most of our sugar sales, Nigel, is focused on the retail segment and the institutional segment. So retail segment is around about 30%. That's what it's been for F23 and F24. We had some opportunistic trade sales in F24 when prices were good. F25, it's very likely that the retail segment will move north of 40%. In terms of realizations, we get a positive delta of about 2.5 rupees to 3 rupees compared to trade price, because our focus is on institutional and on retail.
Okay, all right. One final question from my end then. What about the stake in Coromandel? A few years ago, you all sold some stake. I need to ask you this, before we wind up. Any further plans or no plans at all? Just to reconfirm.
Yeah, no, Nigel, I think we've discussed this in past calls as well. There's no such discussion. The focus is on, the operating business of EID Parry and ensuring that we sort of take our growth aspirations forward.
Okay. Just one final word on debt. You have a long-term debt of around 300 crores, short-term debt at almost 770 crores. Any plans to bring it down in the near term?
So Sonia, the debt, the long-term debt is largely due to the capex cycle of distillery expansion, and I think the capex cycle is largely concluded or will conclude in another quarter. So I think it's important that the distillery business picks up steam to address that. And in terms of the short-term debt, this is because of high inventories. The sugar season has just concluded. It's really working capital related. It will get paid down during the course of business operations.
All right, we will leave it there. Thank you very much, Mr. Murugappan, for joining us and running us through and giving us a real sense of how various businesses are looking like as we get into the thick of FY25 and beyond. That's EID Parry, 634 on the stock. Well, let's shift focus to PI Industries. The company's year-on-year growth has slowed down a bit. Pharma and agrochemicals were under pressure. But the company managed to improve operating profit margins on a year-on-year basis. Let's talk about what the future looks like. Mayank Singhal is Vice Chairman and Managing Director at the company. He's joining us now to take some questions. Mr. Singhal, good morning. Great to have you with us here on the program. Thank you for joining us. Prashant this side. So, sir, you've, on an overall FY25 basis, revised your revenue growth guidance to 15% from earlier 18 to 20%. Could you start here? Which segments is this slowdown in the rate of growth coming from, and just sort of put some qualitative aspects to this number?
Yeah, morning. Good morning. Once again, I think let me give you a quick background about the industry itself. I'm sure all of you are aware that there have been very strong headwinds for the agrochemical industry globally, and there has been a negative growth all across the sector globally. Given that fact, I think PI has still performed well. We've still shown double-digit growth, very closer to line to what our plans were. But I do believe this hangover is going to continue in the global markets for the next year. Looking at that, we have given an estimated about a 15% growth. On the other hand, the company has primarily focused itself on becoming more efficient from a working capital standpoint of view, looking at product mix, and the domestic business has focused on value creation and looking at how we can bring about efficiencies in the process systems while these headwind challenges are. On the other hand, we have contracts which are in place, which are to be executed. A bunch of 7 to 8 new products are coming in both the businesses. And on the other front, we have also recently invested in building the platform areas of pharma, which will have its own colors playing up in the next 3 to 4 years.
Mr. Singhal, in terms of the broader, what you said, right, the backdrop, which has affected your growth guidance as well, when is a turn expected for agrochemicals? And what will signal that, in your opinion? Yeah.
Yeah, so I would say that, looking at what's happened over the last year and a half is that was overstock, as all of you are well aware. I think the destocking piece is now coming to, hopefully in a quarter or two, into control. On the other hand, the seasonal impacts have also been there. Given that if the first season globally goes well and the seasons play up well, I believe this is not more than a year plus of hangover.
Okay. So is there a possibility, Mayank, hi, good morning, this is Sonia here. Just to complete this loop, you've scaled down your outlook to 15% in FY25. Is there a possibility that you may not even meet that 15% given how concerned you are about the global situation?
Well, as I said, the global scenario is improving, number one. On the other hand, as you would know, that we have from what we know, that the best of our estimates, we have pretty well contracted revenues, and we're expecting to definitely see certain growth coming in the domestic business if seasons are favorable. So I think we could well hold on to that number for now.
Okay. And the CSM revenues over there, they de-grew almost 7% if you compare it on a quarter-on-quarter basis because of the decline in volumes. What's the outlook for FY25?
Well, as I said, we've given the same estimates of growth around 15% odd. I think, again, this business, as I mentioned earlier, is not a quarter to quarter. It depends on supplies and situations. It's in certain quarters and product mix, which defines the volume growths.
All right. Hi, Mayank. Good morning and good to see you in. So 15% is the overall growth. Now, if you could break it up for us category-wise. CSM, pharma, and the domestic business. Pharma, last year you did around 320 crores odd. CSM was closer to around 6,000 crores. So if you could break it up for us, what could the difference be?
Well,
Because
I would
pharma,
not
there
have the
should be...
exact breakup here right now, but I can say that primary growth is going to come from the ag-chem space. Pharma is still in the nascent stages. Obviously, we'll see a certain amount of growth there. As you know, that we've been investing to build a unique, differentiated capability here. And that is obviously going to take its time. And in the PI way, we always take our time to put our right strategy before we see the numbers play out.
Okay, all right. What about margins? You know, they're holding around this 26.5% odd. Given the industry headwinds, do you believe that you can sustain it around these levels?
Yes, we believe, and I think we've given that outlook, we should be able to sustain around that level. Yes.
Okay. What's the pipeline looking like now? You have 6 new products that were commercialized in FY24. What is the product pipeline in FY25 and 26? What can we look forward to?
I think we mentioned that we are looking about 3 to 4 or 5 products in the distribution locally. We're looking at 6 to 7 products in the manufacturing piece of the custom manufacturing export, where we are looking at commercializing some of those products for now.
You're also foraying into developing certain chemicals and advanced polymers for semiconductor applications, right? In the non-agri-chem pipeline. What is the potential that you're looking at over there? Because that's a big space now.
Well, it's a big space, and it's highly technically challenging and a complex space in terms of what needs to be done, how it needs to be done. So we're happy to say that over the last decade, we've been actually wanting to play in this space. Today, we're going into commercialization of a certain amount of products which have certain unique technological and quality management capabilities. I definitely see this playing an important role in looking at the potential of this and India's outlook in the semiconductor and electronic space, this space to be a great potential. And having laid our partnerships and footprints in that, I think we should be in the forefront to look at the technological parts of this play.
Got it. Mr. Singhal, just to take you back to what you started by saying, you said a turn is perhaps not more than a year away, right? In terms of all these overstocking issues, etc., to be behind. So in a year like that, with all of this, you're guiding for a 15% growth. What would a turn and then kind of, a regular kind of market mean for prospects? Would you get to the 20-25% kind of range? Once that happens,
I think we need to balance our thought processes here. Today, PI's base has become big. We have to look at the industry numbers, and we have to be somewhere aligning, playing at the skills that we are today. So obviously, that is something, as you know, today, the weather and the climatical situation play an important role in this sector. And I think what one would wait and watch as to how things have turned up. But the PI strategy has always been to look at how we can actually isolate and manage this challenge. And so far, we've been tidying well, specifically given if you look at the present year, where it has been a very strong negative growth, and PI still delivered a pretty strong set of numbers here.
Okay, all right. Mayank, final couple of questions before we let you go. In the pharma business, you were indicating that maybe there could be some more inorganic growth. Are you all on the prowl in the pharma sector? And also, where do you see that number headed in the pharma business itself? Because you were looking for an asset for a while, you've got in there. You're doing around 300 crores or say in the next 3-4 years, where do you see this business headed?
Yeah, I hope to be at least easily, if not triple that number, double or triple that number in 3 to 4 years. And obviously, as you know, the CRDMO space is not about chasing the number, it's about chasing the right play and building the right capability. And just to take you a little back, I think when we built the PICSM business, and some of you may not be not aware, but it took me about 10 years before we could really play the game up. So 98 to 2008, we were investing, building unique capabilities before we really saw the numbers play in, henceforth. So I think that's what we're targeting there. And I think not driving by numbers, but yes, numbers will come through. But it's more about building the capability in the platform to really be able to connect with the customer.
So if it has to triple the revenues from here, it's including some more inorganic growth?
That's not on the, I don't see that as, we have enough right now to do. That's something we will see as and when, if something interesting comes our way. As
so
you know,
1,000 crores from pharma in the next 4 years looks doable.
Yes.
Okay, that 1,000 crores from pharma in the next 4 years. You earlier guided for the fact that new products will be at least 30 to 35% of your total revenues in the next 3 years. Any change to that? And, what kind of contribution do you see from new products in the next couple of years?
Well, I don't have the contributions here, but yes, we guided about 30-35% from new products because constantly new products are coming and they're all getting scaled up.
Okay.
All right.
Sorry. For the big product, Mrs. Singhal, we, pyroxasulfane, as it becomes generic over a period of time, could you talk to us about what's happening there? That's your largest product.
Yeah, well, I mean, that has been discussed. I think it is as it gets generic, PI is a manufacturing part of the value chain, as you would understand. And typically in a generic, it is a marketing side, and the innovator is the guy who decides the strategy there. But we are a contract manufacturer, which is based on a certain understanding, and I see that ability to combinedly handle the generic. I don't see that as a challenge with the kind of understanding technological capability that we put together.
So
In terms of price erosion for the product, could you give us sort of a glide path? What would it look like into the future? You'd have a good sense.
Well, that would not be for me to comment. As you know, I'm a contract manufacturer. It is more of the innovator who has that perception, right? So it holds there.
Okay, so just a final question before we end. This non-agro space, right, which is growing very well, whether it's electronics, semiconductors, performance chemicals, advanced polymers, where are you seeing the maximum potential for growth over the next, say, 3 to 5 years?
No, as we said, we're looking at these advanced polymers, and we are looking at the electronic chemicals. That's where we are focusing as an organization.
Okay.
And pyroxasulfone, you have already told us, is something quite optimistic. It continues to grow in double digits for the next 3-4 years. Do you have visibility on that front?
Well, I can't disclose that given the competitive intelligence and from our confidentially understanding with our customers. I hope you appreciate that.
Okay, Mayank, appreciate you joining in and detailing those numbers. So 15% revenue growth, margins holding at around this 26% odd. The pharma business could possibly triple its revenues in the next 4 years or so. Well, for the time being, we'll slip in a short break. You come back, we'll have Manisha Gupta. She'll be telling us what's going on in the commodity market. Stay with us.
Welcome back to Bazaar Morning Call. Let's get a quick handle on what's happening in the commodity markets. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, I'm looking at the monsoons and the latest IMD reiteration that came in yesterday evening. You know, until the monsoons are on, you will see IMD coming out last week of every month to talk about the next month. And that's exactly what we had yesterday. So 106% of an LPA is what IMD is talked about, and Skymet is talking about 102%. So while this is about normal monsoons, this is about above normal monsoon. But there are some detailings that IMD also did in the evening yesterday. So this is about what we've seen in sense of monsoon in last few years. So 106% is above normal, and this comes in after last year's below normal monsoon. So this year is something that the street is watching quite keenly with right now, because there are various curbs in sense of exports. Import duties are free for various essential commodities, and there are other restrictions as well on many of these agriculture essential commodities. And if it's a good monsoon, then we perhaps are looking at good numbers in sense of crops as well. And so when you look at the detailed forecasting, and this is what the IMD did yesterday, they are talking about above normal monsoons in central and southern peninsula. And that's a good news really, because this is majorly your food bowl as well. When you talk about below normal monsoons, there are concerns still continuing in case of northeast India, while northwest would be looking at normal monsoon. Is the reason when you look at the overall monsoon itself for the month of June as well, the IMD does say that they're looking at a bigger probability of anywhere between 90% on the lower side to 108% on the higher side. Now, these are the probability metrics that the IMD has come out with. 31% probability of a normal monsoon, 32% for above and 29% for excess. And this is what comprises of 90% of your probabilities there. So there is very little chance that you're looking at a below normal monsoon. And even if that does happen, then it's only in case of northeast and adjoining central India there. The rest of the part of India is looking at good monsoon this time around. This is what we are looking at in sense of June. So the overall rain is anticipated at 92 to 108%. Northeast will be below 94%. Is the reason that metric really comes on the lower side there. But apart from that, northwest will look at 92 to 108%. And that's exactly the scenario that the IMD is anticipating for western part of India, southern peninsula and most part of north as well. Now, the June is, while you are looking at an onset of monsoon, but this is not without heat waves that are expected to continue for this month as well. The IMD says that it is about the strong, dry, warm winds, lack of rainfall in the month of May. Also, the fact that you're looking at a reverse or an anticyclonic circulation over southwest Rajasthan and Gujarat is the reason that you will look at these heat waves continue for the month of June as well. So even as we are talking about monsoon, there are heat wave advisories for the next 3 days until the first week of June as well in various parts of Delhi, Punjab, Rajasthan, Haryana and in some parts of Gujarat as well. That might just continue, but the IMD also says that for the next 5 days, you could be looking at onset of monsoon in Kerala. We're also looking at very important kharif crops as we go ahead. So most important really is rice, soybean, cotton, maize and pulses. And then, of course, you have some commercial crops as well coming in. And we are looking at restrictions right now in most of these crops. So if you are good monsoons and we see bumper crops of these coming in, then there is an expectation that as soon as we see the new government coming in, there would be a lot of help. It would help farmers produce bumper crops. It would also lead to restrictions being eased going forward.
Okay, thanks a lot for that. Well, that's on the commodity side, but let's get back to the markets now. Ekta is with us to talk about Natco Pharma and why you should be watching that one. Ekta, over to you.
Well, good numbers which have come in for Natco. It was the highest ever revenue and profit for FY24. There was a one-time charge of 90 crores in the domestic business, but the street seems to have shrugged that off. The numbers have been higher mainly due to the contribution of Revlimid generic. That is contributed on an FY24 basis as well as on a Q4 basis. However, the numbers are below Novama's estimates, which was estimating a little more in terms of growth. So revenue for Q4 has come in at around 1,068 crores. Street was anticipating 1,100 odd crores. EBITDA 497 crores versus estimates of 500 crores plus. Margins 46.6%, which have improved both year on year and Q on Q. And a profit of 386 crores. Street was anticipating over 400 odd crores. So despite it missing estimates, remember it is a very strong growth that you've seen on a year-on-year basis for Natco. The street seems to be extremely positive on the prospects. There is a conference call at 11 a.m. We'll get more details then.
All right, Ekta, thanks a lot for that. Well, let's go across to Vivek now. He has Borosil Renewables on his radar. Vivek, over to you.
Well, like we said, FY24 has been quite underwhelming as far as Borosil renewable prospects were concerned. Revenues, as far as Q4 was concerned, was down 8% on a year-on-year basis, not due to lack of demand as far as India was concerned. In fact, demand outstripped supply, but there has been significant dumping as far as Chinese module makers are concerned, and that is something that has gone ahead and given quite a bit of a knock as far as pricing is concerned. Now, talking about the operational performance and operational loss this time around of a little over 25 crore, and on the bottom line, there has been a loss this time around of over 50 crore versus a profitability of a little over 10 crore last year around. Now, what is the company saying? Number one, overseas subsidiaries this time faced demand headwinds, especially in Europe. Along with that, EBITDA was weaker on the back of two things. Number one, a result due to lower selling prices in India on the back of dumping that we just alluded to, and also lower production in overseas subsidiaries due to much lower demand as far as the European markets was concerned. Now, talking about the key product that the company is, the solar-grade silicon, the prices of that dropped by 80% on a year-on-year basis to 10.3 cents per watt, and this is as recently as May 15, 2024. So overall, there has been demand weakness abroad and there has been price weakness in India. Looking forward, number one, the company is saying that they're going to do a rights issue of almost close to 750 crore. This will be to pay long-term debt, and more importantly, to watch would be the imposition of ALLM that could improve the prospects of Indian domestic module makers.
Okay, thanks a lot, Vivek, for that. That's Borosil Renewables. NMDC is also in focus. Nigel is here to tell us why. Nigel, over to you.
Well, that's right. NMDC's numbers are quite disappointing, but this is some positive news that's coming in there for NMDC, because we understand from sources that effective today, they've gone ahead and they've increased prices. On lumps, they've increased it by around 250 rupees per ton. And on fines, it's around 350 rupees. So there's a rather large price increase that's come about. And that's not all. This is the second price increase we're seeing. Remember, last month, towards the end of April, we did see a price increase to the tune of around 400 rupees on lumps and closer on 200 rupees on fines. Getting into a monsoon, well, this will be good news for them if they can hold on to this. So price increase comes about for NMDC. Some part of the street was factoring in that there could be a price increase, but all this will bode well for the Q1 numbers. Though Q4 was quite disappointing in terms of an operational performance, this price increase could flow through to their operational performance. So that's why, in fact, the street is reading it positively. Back to you.
Okay, thanks a lot, Nigel, for that. So that's NMDC. Let's slip into a quick break. On the other side, Pranjal Bhandari, the Chief India Economist at HSBC, is joining us here in the studio to discuss the expectations from the upcoming RBI policy, post-election reforms, and lots more. Stay tuned. Welcome back. Let's talk about the economy now, because we have several things lined up. There's, of course, the election results. Then there's a full-blown budget that we'll have in July. In the middle, there is an RBI policy as well. Pranjal Bhandari, the Chief India Economist at HSBC, joins in now. Pranjal, she's here with me in the studio, by the way. She's based in Singapore, but she's in India now. So, Pranjal, thank you so much for, first of all, coming here to the studio at a very important time, right, for the economy. We're heading into a big event. It could be a binary event for the market and the economy, but how are you positioned in general, and what is your expectation from the budget in July?
Okay, great. So look, good to be here in the studio. So I think in terms of growth, I think India is in a pretty resilient place. Growth is pretty robust. On Friday, we are going to get the GDP data for the March quarter, and my sense is generally activity in this quarter has actually been better than in the previous quarter. All the PMIs are higher. The construction sector has taken off. It's not just public capex, but it's also real estate capex. Construction creates a lot of jobs in rural India. Rural incomes have started to do a little better than before. And then we've got the RBI dividend, which makes the fiscal consolidation a little less painful on growth. So all of this is coming together, and I think we're in a good place in terms of growth. So, I'm excited for the big events that are coming up. I think India is entering on a place of strength.
Okay, so you're saying growth is robust, real estate capex has taken off, and things are looking good, right? Now, what this market wants is continuity of policy and a smooth transition as well of the new government. The expectation is that the current government will come back to power, and then policy continuity is something that one can expect. But what are you looking at? Apart from growth, what are the 2 or 3 things that the government can do now to strengthen the economy further?
Yeah, so I think the reforms that the government articulates in its first 100 days or so is going to be extremely important for the medium-term growth of the economy. And here I sort of break it down a bit too simplistically into easy reforms and hard reforms. Easy reforms, although they're not that easy, are things that the government has already been doing well and just doing more of that. For example, attracting investment in futuristic sectors. You know, we had Apple, we're getting semiconductors, perhaps EVs. So a bunch of, that, continuing with public capex, ensuring that macro stability is intact, getting some disinvestments done. I think if all of this continues, then we're like a 6.5% GDP growth economy in the medium term. But if you want to aim for more, 7.5% to 8%, which, by the way, we need for the kind of jobs we need to create in the next decade, then I think the government needs to take on much harder reforms. Land, labor, ease of doing business, farm laws. And my sense is we'll know in the next 100 days, what this government wants to really pursue. And the growth dividend would be either a 6.5% growth economy or a 7.5% to 8% growth economy.
So you said easy reforms like continuation of public capex is something that is perhaps a low-hanging fruit. But some of these harder reforms, land, labor, ease of doing business, is that something that you would expect could be taken up in the first 100 days itself? Or is that a tall ask given the way, the macroeconomic and the global situation is panning out?
Look, these are tough reforms like farm. We've already had an experience with that in the past. For this, a lot of consensus has to be built. So I don't think, really getting these bills passed will happen very quickly, but we'll get to know if the government is really pursuing it, if they are starting the conversation, they're reaching out to stakeholders. I think that is something that will be clear in the next 100 days, if the government is actually interested in these reforms in a 2 to 3 year horizon.
Okay, that's about the government, right? I want to also ask you about the RBI's intention. What do you think could happen in the June policy? The expectation is that the rate cuts will be very slow, they will be very shallow. So realistically, what are you expecting?
A very interesting thing has happened in inflation. For the first time in the history of tracking the data for me, I'm seeing core inflation fall at a time growth is extremely robust. And I looked into it very carefully. How come core inflation has halved over the last year? And my sense is 3 things have played a very important role. Number one, Chinese disinflation. China export prices are falling. India is importing many more consumer goods from China. And through that channel is actually importing some of this disinflation. I think this is a very important part. The second part is RBI being hawkish. Now look at this RBI. They were able to bring down inflation from 6.5 to 5, but instead of patting themselves in the back, they keep saying, oh, the job is not yet over, we need to get to 4. They keep sounding hawkish. That in itself is important for driving down inflation. And third is the commodity price fall. The fact that compared to 2022, in 2023, we saw oil prices, metal prices, and all of these prices fall, and manufacturers were able to cut prices. So I think all of this has brought down core inflation. Out of these, I think Chinese disinflation, RBI remaining hawkish will continue. But what I'm beginning to worry about, and I think a lot of people are not talking about it, is commodity prices. Year to date, commodity prices across commodities has risen by 11%. I think that's pretty high. And my sense is, given global demand has surprised on the upside, this is something that could continue and that would come in the way of the RBI really easing. Does the RBI really have to ease? Not really. Growth is robust. A little bit of easing can happen via liquidity. Remember, in June, July, once the government starts spending again, once we get all of these index-related bond flows coming in, liquidity will be looser. Some effective rate cut will happen from that route. So my sense is, putting all of this together, if we cut, we're going to cut minimally, not too much. We have the Fed forecast of Fed cuts of about, 1 this year, 3 next year, overall 4 rate cuts over a 1 year horizon. I think for every 4 rate cuts the Fed gives, I think RBI can cut by about 1 or maximum 2.
So in the June policy, at least, there's no expectation of a rate cut.
No.
In September, is that your base case?
My sense is no. I think we'll wait for the end of the year. Our Fed forecast is for the first Fed rate cut in September, and there's a lot of uncertainty even about that. So we'll see where that goes, what is the impact on the dollar, and I think the RBI will first start considering it in the fag end of 2024.
Okay. I wanted to come back to the economy just to understand what else can we expect, from post the election and from the budget, right? Where are we at in terms of a pickup in the capex cycle? You spoke about real estate capex picking up. Corporate capex, I think, are seeing some green shoots. How is the rural economy looking? What are some insights that you can share with us?
Yeah, so 2 points here. We got this RBI dividend, this big bounty of 2.1 trillion rupees. It's about 1.3 trillion higher than the government had estimated and budgeted. My sense is that they could split it between saving and spending. So about half of it they could use to lower the fiscal deficit and to lower the government borrowing. So by about 600 billion. But the other half it could use for welfare spending, and that's something to look forward to in the budget. When we had the interim budget in February, capex was well provisioned for, 17% year-on-year growth. That's a lot. You can't do more than that. You don't have implementation capacity on the ground. But what was under provisioned was welfare schemes. It was actually cut by 0.6% of GDP. So my sense is that we will provision for that a little more, and we could see a little more welfare schemes out there, which, by the way, will be great for consumption, for mass consumption, which indirectly will be good for capex. Now, coming to capex, public capex is great. We've been seeing that. But it's only 25% of overall capex. The big question is, when will the remainder, 75% private come? So there are two parts to it, domestic and foreign. Domestic is waiting for capacity utilization to rise, for mass consumption to rise, and if the government can have some welfare spending in its budget in July, then perhaps that will help, increase the prospect and improve the prospect of domestic capex. Foreign capex is a little more problematic. We all talk about nearshoring, reshoring, but if you look at the hard data, not too much has happened. Too much of manufacturing chains haven't yet moved. So we'll have to work harder. We'll have to do all of those reforms, ease of doing business, land, labor, if we want to get a lot more of the foreign capex to come in. But overall, if a little bit more focus on welfare spending, I think mass consumption will be better and we could start seeing some domestic capex pick up.
Okay, so the focus is on welfare spending and hopefully that will help pick up mass consumption. Pranjal, thank you so much for joining us here, coming to the studio, and we have big events upon us, so we'll try and touch base with you once those events are out of the way. Well, with that, it is curtains down on this edition of Bazaar. Thanks a lot for watching. The market is fine, actually, holding on around the 23,000 mark on the Nifty. The mid-caps have slipped slightly into the red, so don't lose sight of that. The mid-cap index is now down about 80 odd points, so it's getting a bit volatile for the market. Chartbusters will take all the action ahead.
Nalco climbs as fourth quarter numbers beat estimates. The EBITDA for the company for a quarterly level comes in at the highest since March 2022. The stock also is out of F&O ban, further bolstering the up move.
United Spirits has shares. The management in its post-conference call guides for double-digit volume and revenue growth for FY25 for its prestige and above brands.
Inox Wind and Concord Biotech both slump on the back of large trades. Meanwhile, shares of Timken zoom after 6.5% equity changes hands.
Well, the Natco Pharma climbs close to around 3.5% in today's trading session, despite reporting Q4 numbers which were below estimates, as Revlimid generic contribution drives its earnings. Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangala Malu. And if you look at the top of our screen, well, you'll see the headline indices are doing quite well. The Nifty is up, the Bank Nifty is up, but your portfolio may not be feeling too good because we have more number of stocks that are declining in comparison to the number of stocks that are advancing. So the ratio right now is around 1,400 stocks down to around 850 stocks that are up. Mangalam, I think a bit of a sideways move is par for the course ahead of that big election verdict. In the next 5 sessions, we'll have that verdict with us. For the time being, maybe some consolidation is what the bulls will take.
Consolidation is what the bulls will take. I mean, you have the expiry, you have, you have the election outcome. Before that, you have the outcome of the exit polls, and all of that will play out. So, which is why maybe, bulls would take a bit of a pause for breath. But if your portfolio has a couple of these stocks like AB Fashion, that's moved higher at the high point of trade, reports its results today. Jubilant Foodworks has suddenly found some wind beneath its wings. In this week itself, that stock is up around 9%. And then you have a couple of movers from the broader markets in the form of Torrent Power, Aditya Birla Capital, Max Financial and Exide, all of them doing well. But largely, you have more number of stocks which are declining than the number of stocks which are advancing. And that's something that the advanced decline chart should tell you. In fact, that has been the case for the last 3 or 4 trading sessions as well, where even as the markets continue to move higher from the frontline end of things, the market breadth was either skewed towards decliners or maybe at an even scale itself. So that's something we'll keep an eye out on. But in a market like this, what are the ideas for profit? Let's shift focus to our session segment. We get you some ideas for profit coming in from our colleagues at Money Control Pro. Khushbu Rai joins in with a stock that she's been tracking.
Today's idea for profit is Godrej Consumer Products. The company registered broad-based volume growth in the March quarter. The premium categories saw double-digit growth as compared to mass categories like household insecticides, while the acquired businesses saw good traction led by synergies. The high single-digit underlying volume growth target for FY25 will be led by rising penetration and category development. As innovation and sales and distribution network expanded twofold since 2020, the newly acquired businesses will increase the company's total addressable market going forward. In the core home care category, incense sticks have formalized the unregulated market, while the underpenetrated liquid detergent segment saw good growth in the medium term. If we look at the valuation, the stock is trading at a premium valuation of 53 times FY26 estimated earnings. But we believe it offers upside given the sustainable performance in India and Indonesia and a scope to improve margins in the remaining businesses.
All right, that's an idea for profit. But let's talk about the management of a company that joins us now, TVS Supply Chain Solutions, in focus on the back of their fourth quarter numbers. The company's overall revenue grew about 4.5%. However, for the integrated supply business, there was a double-digit revenue growth. We have 2 Ravis with us, Ravi Prakash, who's a global CFO, along with Ravi Vishwanathan, who is the managing director of the company, joining in. Thanks a lot, gentlemen. Both Ravis. We'll address you all as Ravi Prakash and Ravi Vishwanathan when we're directing the questions to you. For the year, if we look at it, we've seen a decline in your revenues. 10,000 crores has come down to around 9,200 crores, but we've seen an improvement in the margins. So let's start with the outlook for FY25, as it were, Ravi Vishwanathan, that is. If you could give us a sense of what's the growth that you're targeting in both your segments in FY25?
So let me actually qualify that answer first by saying FY24 was a very interesting year from an ISCS perspective. The segment grew double-digit, and it has been a significant growth that we have had over the last 4 quarters on the ISCS side. And looking at FY25, we expect that to continue. We expect to continue double-digit growth on the ISCS segment. If you look at FY24 and look at the network solutions segment, globally, I would say the trade volumes have declined, and that has had an impact on the freight business globally. And this is nothing unique to TVS Supply Chain Solutions. And we've been talking about it over the last few quarters about the suppressed demand, and also the fact that the wars are not helping. The Red Sea situation has also created certain uncertainty. So I would say that when we look forward, we are very bullish about the integrated supply chain solutions. We are focusing really on the profitability of our network solution segment while we continue to look at all of the opportunities for growth. So it's very difficult to put a number on the growth for FY25 for the network solution segment. Our focus really is about to say, how do we make sure that we are growing profitably, ensuring that we are moving all of the levers in the network solution segment to deliver profitability, while we continue on the integrated supply chain solution side with double-digit growth. Having said that, I would say that we are very confident with our strategy. Our strategy is really about customer acquisition and customer mining. You can see that our Fortune 500 customer has increased from just about 64 2 years ago to 72 last year to 78 in the year that just ended. So it's a significant expansion of our Fortune 500 customer. Our strategy is really about that. Global accounts, look at selling capability to our customers in the global market that we are present, and then deep mining our customers. And all of that is paying rich dividends when it comes to our overall business, and especially in the integrated supply chain solutions.
All right. Good morning, gentlemen, and good to see you, Win. So would it be fair to assume that a double-digit growth is something that you all would aspire to do? That's point number one for the entire business. We're talking about the entire business at large. And also, what was encouraging in the past year was that margins have steadily been improving. Do you think that kind of an improvement could continue, going by some of the factors that you just mentioned in your introductory note?
Absolutely. And I think double-digit growth is the focus of the company. And that's our aspiration. We've always spoken about profitable growth. And regarding margins, I think if you look at it, and I'll ask Ravi Prakash to comment on it, if you look at it over the last 3 years, our growth and margins have been significant. Even if you take the revenue, our growth on a CAGR basis has been something which is very impressive. So specific question to answer, yes, and I'll probably have Ravi Prakash give you the details on what we are looking at, both from an FY24 and a trend line which you can draw from there over the last 3 years.
Specifically on margins, I think if you look at our numbers, we started, Q1 was tough, but Q2 we had a improving profit before tax. Q3 we broke even. Q4 we delivered a PBT in the black. Each quarter has improved versus the prior quarter, and that we expect to continue in the next 4 quarters coming. Number one. Number two, we've always said that every year we would try to expand our margins between 50 to 100 basis points, both at an EBITDA as well as an operating income and PBT level. And that medium-term outlook continues, and we expect to deliver that quarter on quarter.
All right, 50 to 100 basis points margin improvement. That implies that by FY26 you would be in the double-digit range when it comes to the EBITDA margins itself. What's interesting is that you guys have also been seeding some new businesses, and that's almost 9 to 10% of your overall revenue mix right now. So let's ask Ravi Prakash, do you have any incremental target on that one? What is the contribution that you would likely to see from, the new business developments that was just about 10% in FY24 revenues?
So historically we've done between 10 to 12% of the closing revenue. So we expect to continue that trend. In fact, that is the number one focus of the company. If you look at it, we've been trying to grow organically through new business development. So we don't expect, in fact, if anything, we want to push that even harder. So going forward as well, at a minimum, we would like to do 10% of the year-end target through new business development and push that even more. And that's where, you've got the order pipeline up on your screen. That's what gives us confidence that we will be able to deliver that.
Okay, all right. Let's focus a little bit on the balance sheet. Post your IPO, the interest cost has come down substantially. I think you were guiding for 30-40 crores of interest cost reduction. Could you tell us what is the current debt in the books, and is there scope for further improvement? If yes, quantify it.
So before we went into the IPO, we had a gross debt of almost 1783 crores, and now it is down to 794 gross debt. So a couple of good things. Today, we do not have any long-term debt. So we had signaled in the IPO that we would use the proceeds to pay down all our long-term debt. We've done that. The debt that is on the books today is purely working capital. And in fact, if you take the cash into account, the net debt is just around 200 crores. We don't expect that to move materially over the next 12 months. And that's the reason, if you look at the Q4 interest cost, which is around 16.6, 17 crores, that's what we are guiding towards for the next 4 quarters. Any increase would only be because if there are any substantial projects coming on board. Otherwise, we are targeting very tight working capital management to get the maximum leverage from the one-time capital structure restructuring we've done.
All right, let's go back to Ravi Vishwanathan as well. Ravi, 30% of your revenues come in from India. The world is talking about India while you are getting 70% of your revenues from the rest of the world. So are you looking to increase that part of your pie? And at the same time, is there any differential in the earnings that you make from business in India and business abroad?
Yeah, I think our focus, of course, is to tap on the opportunities in India. There is tremendous economic activity in India. But I would also say that last year was a bit sluggish when you look at the overall opportunity in the supply chain side. And if you do a comparison with the peers, you'll probably see that most of the peers have been in that narrow growth range. We expect this year, hopefully post-June, to have a normal economic activity or even better, and we hope to tap onto it. The second part of your question, yes, there is, obviously India is really about volumes and trying to grow the business faster in India. So we would be willing to look at a slight dilution in the margin when we compare with the overseas business. In that way, I think the portfolio mix that we have, 70-30, 70% coming from overseas and 30% in India, really helps for us from a ability to invest in businesses in India. See,
do you have an aspirational target of do you have an aspirational target of how much should eventually come from India?
I think over the next couple of years, we would like that mix to go to 35-65 from where it is currently at 30-70. The nature of businesses outside of India are typically large outsourcing deals. We mentioned it about 3 quarters ago when we won a large deal with Centrica in the UK. That is going to open up doors for us for these large transformative supply chain engagements. And today, I can say with confidence that we are very, very well placed in handling those kind of large deals, which otherwise we were not probably being invited 2-3 years ago. Engagements like Centrica have placed us there. And I think the points that Ravi Prakash said, I think we are very fit. We have a fit balance sheet, and it positions us very well to participate in these large deals. And I can tell you that the 4,000 crore pipeline that you saw, we have quite a few which are very large deals that are the pipeline.
Take that point. Thanks a lot, both the gentlemen, both the Ravis, for stopping by, giving us an outlook on your business. A look back in FY24, but more importantly, a look ahead for FY25 as well, with a double-digit revenue growth that you're looking at in your integrated supply chain business. Margin improvement of around 50 to 100 basis points, with net debt remaining at that 200 crore mark. And the eventual target is to perhaps increase your revenue coming in from India on account of the large orders that you won. Gentlemen, wish you good luck. With that, we'll slip into a short break now on the show. But as we do that, let's get you a small little programming note. Join us live on 31st May at 5:30 p.m. onwards. In fact, CNBC-TV18's Future Female Forward, the Leadership Circle, is underway. It's a transformative platform where leaders from diverse fields will venture beyond the traditional discourse and share stories of grit and determination, and also talk about the roads less traveled. This Leadership Circle is not just about business strategies and professional accolades. It's about delving into the depths of personal journeys of these trailblazers that we're talking about.
Welcome back. A few pharma names actually are slipping a little bit from the top. Remember, some of them have rallied quite a bit. Strides Pharma is under some pressure. That's come off the day's top. You have Glenmark Pharma that saw a big run yesterday. That's shaving off some gains as well. So that comes up for you in the screen. But I think one of the stocks that's done very, very well in this month is Jubilant Foodworks. That's up 3.5% today. It's up closer around 10% for the month itself. And as we speak, it moves to the high point of the day. So that's a stock to track. Persistent System has got something going for it as well. Yesterday, it was an outperformer in the mid-cap IT space. And today as well, from the day's low, that dip got bought into. So I think that one should be on your radar. Sudeep Shah of SBI Securities joins us for a technical check. Hi, Sudeep. It's been a while since we spoke. What's your view on the index? We're close to around 23,000 odd. The levels you'll be looking at on the index and the Nifty Bank. Do you think it could get to that 50,000 odd mark sooner rather than later?
Good morning, Nigel, and thanks for having me on the show. Yeah, see, from a